Hello, I'm Steve Carver, speaking with you from my home office studio in Dunn, North Carolina. I'd like to welcome all of you on board and let me join you on your entrepreneurial journey as you go along with me. This is my presentation number 1116. So I've given one or two of these webinars before, and I hope indeed that you enjoy this one. I think we've got some brand new folks here, so it's a pleasure to meet you. Let me invite you to turn your mics on if you would and ask questions anytime you want to, and we'll move along. Today we are sponsored by the Small Business Center, Greg Hannibal at Kinston with Lenore Community College. A great center with a fantastic director, which I love to work with, and I'm sure that y'all will as well. If you'd like to set up an appointment with Greg, his number is here on your screen, 252-522-8021. So give Greg a call and I'll get you an appointment and he'll help you any way he can. The service is free and it's professional. So Greg, thank you very much for sponsoring this, and we'll look forward to having a little learning session this afternoon maybe. He does have a request for you that you will get a survey, a questionnaire survey after the webinar. Please it takes less than a minute to fill that out, and it's really helpful if you'll do that and send it back to it. You've been emailed, if we had your information up front, some study guides, and I call it study guides. One of them is listed as 1116, and that'll basically be an outline of what we're doing this afternoon. Plus there'll be some extras in there to give you some extra reading and maybe some helpful hints on those that you might want to put in your business file. My job is to motivate folks and be assertive in some way to help you be more encouraged to take that next step in business. However, you're here at your own pace, and we're certainly glad to have you and don't want to put any pressure on you that you don't want. But we'll help you get to that next step if that's what you're after. Let's use the chat button over there. So please unmute your mic so that we can hear you. Welcome, everyone. Oh, that was Greg. Okay, I see him right in there. Thanks for using the chat button. I'll fill in there and register if you would, or ask questions or make requests. And at the end of the webinar, I'll take that information down and try to email you what you've asked for. Let me mention to you that we're talking about tax prep this afternoon, but tomorrow night we'll be starting a brand new, what we call Academy series, where I'll be teaching at 6 to 8 p.m. on the next 7 Wednesday nights, a whole series of lessons stacked together and linked together to help you get your business started. And we'll cover probably 300 different topics. If you'd like to be a part of that or learn more about it, I'll be glad to send you the information. With my seminars, the login signs will always be the same. So save your sign-on information today, and if you attend these Wednesday night sessions, you'll be using the same information to get to my platform. Today our topic is thinking about tax prep, how to get our new business started in the tax situation as easily as we can, but also as best we can without having to spend a lot of money to get started. So I invite you to turn your mics on at any time. This is important that if you have questions that you ask them. I'm not sure that I can answer them, as I'm not a tax attorney or an accountant. But after being in business and running my own business every day for over 60 years, I can certainly go back on a lot of experience. But if I don't know the answer to something, I'll just tell you that. But I might be able to give you a helpful hint on how to solve your problem that you're dealing with. So this is free, informal advice. And always the bottom line is, when every business is a little bit different, every situation is different. So it's always good to consult with an experienced tax person or a bookkeeper or an accountant who can give you direct information and be accountable for you. So let's just kind of talk in general about things that you want to consider as you're starting your new business or in your first few years of it. And this conversation is new. As a matter of fact, the first day I've used it, after putting it together, And I studied a lot of online articles, magazines, and especially found one I liked by Mr. John Blake over in New Jersey, and threw in information that I've been using in my webinars as we go along. So some of this ideas and I got from other people. Glad to say that. But number one, which we've always taught, is preparing for taxes starts back when you're preparing to start your business. So you really want to have a good business plan so that you are planning to keep good records, separating your business, personal business from your business, having a plan to grow your business, and part of that growth is how you might use depreciation to get there, when and why to buy different things. And also right from day one, I want you to be considering making contributions to your retirement plan or to insurance policies, ever how you plan to save your money and have your security. And having those two factors being a part of your business plan is important, and it's important tax-wise, so that maybe you can use some expenses as deductions and end up with the asset at the end of the day and not have to pay taxes on it. So that's called tax avoidance, which I don't preach is a good thing, and where tax evasion is not. But if you don't have a business plan, let me ask you to consider getting one. If you don't know how to start that process, then let me invite you to start joining our Wednesday night sessions for the next 7 Wednesday nights, and you'll get a lot of information and be well on your way. Number two is we're going to dive into this afternoon. Taking advantage of tax situations usually focuses on how you capitalize your assets and how you depreciate them to not have to pay so much tax money out, and take advantage of the fact that you are growing your new business. When you buy a piece of property or equipment, it can make a significant difference to you as far as getting a break on your taxes. So we don't talk about that this afternoon a little bit. I don't give you a bit of knowledge on it. But if you are buying a lot of equipment or assets, you'll want to dig as deep as you can on it, because that'll help you save right much money. Good advice is the key. I rely on my bookkeeper and accountant heavily, even though I've been in business for a long, long time. There's new things happening all the time, and my business, like yours, will be changing. Every time we add or take away a different profit center or have a different type of expense, it's really important that you have a good idea how that's going to fit into how you're running your business and how you're putting it together. So your bookkeeper or your accountant could be able to offer you more than just tax returns or financial statements. If you find one you can trust and can communicate with that knows a little bit about your business, make it a point to share your concerns or ask for their ideas. That's why it's important to shop for the right one, because some bookkeepers and some accountants have no clue what's going on with a business like yours. So make sure that whoever you're relying on for advice understands how your business works. And so you keep shopping till you can find someone. They should work with you all throughout the year. Anytime that you can, schedule a regular appointment to look over your profit and loss statements or your bookkeeping records to monitor and see how your profits are coming along. Cash flow is so very important, and your business plan and watching that cash flow will have everything to do with that. Catching the little things before they become a big flood of problems is a major way to help to stay sustainable, other than waiting and go through a whole year and then figure out you've been doing something really wrong. That's going to hurt you badly. So monitor your business carefully as you go, and at the end of the year you'll have fewer tax problems if you do. The IRS really has some really cool ways of knowing how much income you got. But if you are working as a salaried person, you don't have that W-2 form. But that usually, definitely that's going to be listed on your tax returns. But as businesses and as individual contractors or sole operators, If someone pays us over $600 a year for anything, any service or product, then they, as a business, are supposed to file a 1099 form on you. And you'll get a copy of that, but more importantly, the IRS gets a copy of it, and it's automatically, that number that they're reporting was in your income is automatically computerized and goes into your file with the IRS. So you want to be very much aware of 1099 forms that are coming in to you at the end of the year. Sometimes they come by mail, and then sometimes maybe the person that is doing the 1099 to you don't have your mailing address or whatever, but they are going to send it to the IRS whether you get a copy of it or not. So an important tax tip right now is as the year progresses and you're doing work, if you notice someone's paying you more than $600 for products or services, they are required by law, as you are when you're paying people, to file that 1099. Now, where is all this coming to? You want your tax return to reflect the same total of income as the 1099s that come in. So that's why it's important that you do that, so that you're not going to get a surprise related to not having those 1099s equal out on your tax returns. It's an important topic, but usually with entrepreneurs that we're working with at the Small Business Center, with fairly very small businesses or startup businesses, not that big a factor, but you really want to have your your business classified in the class that will serve you best tax-wise. Large, heavy debted companies having lots of inventory like tractor dealerships or car lots and things like that. An LLC business is probably not practical for you. You've got just too much paperwork to keep up with, too many assets, too much depreciation to keep up with. But most of us that are starting small businesses, getting started, the LLC, limited liability company, 99% of the time recently, that's what folks are filing with. But as you're doing that, I suggest that you talk to a CPA accountant, tell them what kind of businesses you're getting into, what type of revenues you kind of expect to get during the first 5 or 6 years, and let them help you determine whether or not you want to be an LLC or a subchapter S or a limited partnership or otherwise, or a nonprofit. So that's going to be important for you. And if you have any questions about that, of course, Greg might be able to help you as well, and I can help you get on the right foot started. But classifying your business is going to be very, very important. I will mention to you that we are recording this so that tomorrow I'll be able to email to you a link to a YouTube video of this presentation in case you want to go back and look at any of these slides or save them to help you remember what we said if you have something you want to apply. Keeping our business expenses separated from our personal expenses is very important. And in a perfect world, we would definitely do that without any qualms whatsoever. But as entrepreneurs, sometimes it's kind of tough to do that as we're operating with a small amount of money to begin with, and number two, I am my business, so what I do personally is doing the business. I'm always in a tug of war going one way or the other. One thing that will help you is to have a different checking account for your business and have different credit cards for your business. And that way, when you can, you separate those. And when you're doing your bookkeeping, it's a good thing to be able to do that. One of the things, that I deal with often is I believe in pledging and tithing, and whenever I'm going to church, I usually before I leave in the morning, I'll write a check to the church to carry. Sometimes I grab a company check. Sometimes I use a personal check. Either way, the church will give you credit back for it, but you can keep everything separated out if you can. Your personal expenses versus your company expenses. Now, a little later on, when we're talking about deductions and different things that you can deduct, I'll show you some areas that you'll definitely want to set up differently, and probably even set up your chart of accounts in your bookkeeping system separate to help you keep them separated. Getting started in business, there's a learning curve here, and we think we know how much money we're making until about we put a pencil to it at the end of the day or end of the month. But it's important that you know the difference between net income and gross income, because indeed you may be bringing in a lot of money, in other words, bringing in a lot of income. But how much of that income is actually going to end up becoming margin or profit? That's where your bookkeeping and your taxation issues come into play. So depending on what you're buying or selling, it's important that you know how much you've actually got in it at the end of the day, and then that will become compared to your other expenses, general overhead I'm talking about, for you to figure out what your overall margins and or profitability are. Just because you're selling something, because you buy it for $100 and sell it for $500 certainly doesn't mean that you made a $400 profit. You indeed made a $400 margin, but that's not profitability. Why is that important? Because a lot of folks say, look, I'm making so much money, I don't have to pay so much taxes. I'm kind of afraid of this. And doing that, we lose sight of what our actual net profit is going to be at the end, because that net profit is what you pay your taxes on. You take all your gross income and subtract all the gross expenses, and that's what's left is your taxable exposure. And so as you're going through doing business, you really want to end up with as much net income as you can. But you need to remember that that number will be taxable. Keeping adequate records, which we'll talk about later, and saving them in such a way that you can find them for your customers and find them for yourself is an important part of small business taxes. And having a chart of accounts that makes sense to you is important as well. That chart of accounts is the different labels that you put for your expenses and your income in your bookkeeping system. And having those broken down and identified can really help you at the end of the year when you're trying to figure out what your deductions are. So if you keep that in mind as you're getting started, it'll make a major helpful difference for you at the end of the year when you're doing your taxes. Finding that good record-keeping system in the long run is going to help you find more deductions at the end of the year. Keeping up with those expenses and put them in right categories each month indeed will help you find those deductions and apply them. Lastly, I want to mention to you that payroll is kind of a complicated thing, especially if you got a lot of employees or you've got a lot of deductions or things that people are taking expenses out of their payroll before they get them. So sometimes it's depending on your situation, how much time or expertise you have in this matter, sometimes it's a lot better just to get a payroll company or a virtual assistant to help you with payroll so you can concentrate on running your business and making your sales, calling on your customers versus getting tied down with a lot of paperwork. And that's a thin line, and it's an edge that we all have to work with. I do a tremendous amount of my bookkeeping work here before I give the paperwork to my bookkeeper. And it would be nice to have an employee to do that for me. But right now I'm able to manage it myself, keep my expenses down, so that's what I do. And if you're not careful, you can hire too many people to help you with jobs you can do versus doing them yourself. But we got to remember, we have to find the time to do our selling and to look after our customers. So sometimes it's just absolutely necessary that we hire people to help us with jobs that can free us up so we can get our business, keep it alive to do it. But I mentioned here now that the payroll issues, yes, I do recommend that you have someone help you with it if you need that help. But here's the key. That is probably the most serious security issue that you will face, because when you're giving people access to your checkbook and your payroll records, and you're expecting them to pay those taxes for you to the federal withholding taxes and state taxes for your employees, and they don't do it, or they take the money instead of paying the taxes, then you're going to be on the hook. So having someone do your payroll for you definitely means that you're making a deposit for that estimated payroll each week or month or 2 weeks, or how often you have payroll. You've got a good idea on how much to give them authorization to write the checks out to the employees. Otherwise, you're going to run a risk there that someone may not be as honest or accountable as you would like for them to be, and that can get to be a real big problem really quick. So those kind of the ground rules. Now we'll jump into specifics looking at them. Again, if anyone has a question, just break in and let me know. Is there anyone else now that, can y'all hear me okay? If you can't hear me okay, how about just writing in chat that you can. I see some chat things here where someone may be having trouble, and you may need to turn your volume up. My volume is wide open right now. So we'll move along, okay? Thank you for all of you joining in, and I apologize for the trouble we had at the beginning. We had some network difficulties, but they seem to be ironed out now. Let's talk about record keeping to begin with. All your taxes get back to keeping records, and there's some records that you're supposed to keep forever and ever, and some that you need to keep for 7 or 8 years. And so let's talk about that a little bit. First of all, it's a good idea to go ahead, if you're just getting started and getting set up, go ahead and get you a few filing cabinets. 1 or 2 4-drawer filing cabinets usually get you started out. You can get your folders and your folder hangers in there, and are able to keep stuff sorted as you go. And that is a big job as your business will grow, is keeping those records good. But you got your emails, you got your accounting, you got your invoices, you got all different types of records to be kept on computer files as well as paper. Yeah, they said that when the computers came out, we wouldn't have to worry about doing paperwork. Well, that's a bunch of BS, right? So we don't need to handle both. But get used to using flash drives, the little thumb drives that you can plug in and out. There's an easy way to save items. It's an easy way to carry the information around in your pocket when you're traveling or doing things. And it's a good way to download onto your flash drives on a regular basis. Set those aside, just say this is file records, and keep a supply of flash drives that you can always save your information as you need to do it. In today's world, with the cloud on the computer system, there's a lot of organizations that offer saving your records off your software automatically, and you can do that. There's some devices that you can put disk into your computers and download and take those disks out and put them away all through the year. I've used all of the above through the years, and right now I'm just enjoying using my flash drives and saving files on 2 different computers. One kind of as a safety measure in case one of them blows up on me. And so far that's worked out quite well for me. Paperwork-wise, you want to consider having your paperwork files in a place that will probably not get flooded or wet, and will probably not catch on fire. Fire and water is what destroys files, of course, and if it's a hurricane or tornado, wind involved too. That's all risk management, but give it some consideration. Try to find a safe, dry place for your files, and a place that if we do have a disaster, like a hurricane or a tornado comes through, that you've got your filing cabinets in a safe place that you think you'll be able to go get those records out, like your insurances and titles and those type of paperwork files. You don't want to take a risk with losing those. The ultimate safest place is the safety deposit box for those records that you need to keep permanently. But safety deposit box rental can get to be very expensive as well. So think about that. It's something to consider. Some items that you don't have to keep forever permanently are your corporate documents where you got your business incorporated. As your accounting forms start piling up through the years, you need to keep those. Anything related to selling stock in your business or your stock certificates, if you're buying real estate, deeds and mortgages, and of course if you're buying vehicles where titles are involved. If you're buying an asset that does not have a title, like a tractor or a large piece of equipment, a saw or something like that, I want to recommend to you that just put in the back of your mind, if you're buying an item, say over $4,000 in cost, that you save a copy of that purchase invoice. That purchase invoice will be what will be referred back to if you lose it or have some type of claim. And also if you're trying to figure out your depreciation sheet sometimes to be able to do that. But it's not required by law that you keep those purchase invoices, but I suggest that you do for your assets. Records that you don't keep permanently include tax returns, of course, license and documents and such as that. McDonald, did you have something to ask? Hi there. Okay, maybe your mic's just on. I don't mute it, but if you want to come back on, just unmute your mic. You'll be fine. Trademark registrations are really important. So you'll put these kind of things where you put your cash and your valuables, because these documents can be very, very important to you. And indeed, a small safety deposit box is usually a good investment for anyone that has their own company. You don't need to buy one that costs you more than $100 a year, probably. Now, not permanently, but 7 or 8 years, and I say 7 or 8. The law requires 7 years, but I like to say 8, because so often every year you'll get tax documents that come in when you're not doing your regular tax work. And what I do is I just put those documents in that don't require any bookkeeping work, but I'll put them in the box that's dealing with this year, even though it may have something to do with it happened last year. So I save my records at 8 years instead of 7. The law requires 7. But there's a whole list of things here we need to keep. There are different types of contracts, employee records, expense reports, things like that. And one that I'll mention especially critical for folks who may not know, and that's called a bill of lading. A bill of lading is a shipping document that says you shipped something to a customer from your location here and went to their location. Or you had your vendor ship it direct to them, such as that. And items that are shipped out of state, sometimes you don't have to charge that customer sales tax in different states for different products. But it can be a really good sales tool for you if that's part of your market. And gives you a tremendous advantage on other folks that are in state where that customer is buying from. So you don't need to keep a copy of those documents, because if the North Carolina DOR decides to look over your records and they see this invoice that you did not charge tax on, then they're always going to ask you why, because they feel like that's money that you didn't collect for the state. So every invoice that you write, the state's going to ask, why didn't you charge tax on it? And the answer will be, it was exempt. One, because they were out of state, could be the answer. And if that's the case, they're going to say, well, prove to me that you shipped this item out of state. And that's where the bill of lading comes in. So I've come to recommend that when you're selling items and you have shipping documents, and especially if you can do it yourself or you have a bookkeeper to help you, that I don't consider that deal closed until my paid invoice goes into my filing with a copy of that shipping document stapled right to it. Or that when I finish up my document, my invoice to the customer, I have listed on there how it was shipped with a pro number and a date and exactly where it was shipped to. Because those are questions that you will have to answer tax-wise, okay? Sales tax returns are going to be important for you. Different invoices, payroll records, your canceled checks and checkbooks, you'll want to have those organized in numerical order so you can go back to different months and find certain check numbers very easily, very quickly. And I say that so easily, very quickly, but all this stuff is crammed into a box based on a year. So every time you open a box, there's some more stuff to do. But that's as easy as it probably will get if you don't have it computerized very nicely. We live in an area where tornadoes and hurricanes come through and occasional floods. If one does come through your area, then possibly your business might become eligible for some grants or low interest loans from the FEMA organization, the Federal Disaster Organization. I mention this because if that happens and you go to FEMA to ask for some help, they're always going to ask you to bring your paperwork with you to show you how much money you've been making each month and about your business to do that, your profit and loss statements or maybe some sales records, because they're going to reimburse you for profits that you lost, not sales that you lost, but the average profits that you were doing. So you don't need to come up with records when that comes into play. And that becomes very important. It kind of tells us that at certain times it's a good thing to show that you're making a goodly amount of money. If you were in that situation asking for a grant for lost profits. However, the more money you show you're making, that means the more income taxes you're going to have to be paying. But as new businesses, we need to be making money. We need to be paying those taxes to satisfy our creditors and give us plenty of room for growth. We won't be afraid of that, because after the day, you're going to understand that depreciation encourages you to make more money and to spend that money on your business. And when you do that, you'll get a tax advantage that'll lower your tax exposure. So I know this is not the most exciting topic in the world. It's not like marketing and doing advertising, but indeed it is important. So there's two types of expenses in business. There's a business expense, which is basically the cost of doing business in your trade. And after you make this expense, you don't have an asset to show for it. It's gone. It's intangibles. It's like renting your business, or travel expenses, or payroll expenses. Those are items that are 100% deductible as a business expense. And if you spend that money, it automatically reduces your tax exposure because it's lowering the amount of net profit that you'll earn. That's your business expense. The other expense is going to be called a capital expense, when you're capitalizing your money, when you're taking your cash and you're buying hard assets, tangible assets, as capital expenses. Those are usually pretty high-ticket items, maybe $1,000 or more. Don't have to be that much. Items that will last at least a year. Items that will be accountable, and that you can point your finger to it and say, this is mine, I own it, it is an asset. This is mine, I own it, it is raising my book value of my company. So here I've used the word book value. I'll use it a lot more this afternoon. And that book value is how much your assets were worth when you bought them, less how much they've depreciated. Fair market value is the value of those items if you were selling them out in the real world. If you were going to take the items, no matter what the book value is, and sell it, that'll become your fair market value, which we'll talk about. But specifically now, we're going to focus on capital expenses because that is so important for your depreciation and for your taxes. So let's now move and talk about depreciation a little bit. Now, we've heard the words appreciate. I appreciate your business. And, but we've also heard the word depreciation, which is, we hear it oftentimes when we talk about a car or a vehicle. We talk about houses and real estates, which indeed can depreciate and oftentimes do, but they can also appreciate, which means the value goes up. But this afternoon, we're going to talk about depreciation because that is a taxing issue. It goes real deep, and you could spend the whole year in college studying depreciation in a million of different ways. It might apply to different companies. I don't think we really need to do that, but you really need to know a little bit more than what I have time to teach this afternoon. So I found on the internet from Lisa Borgo a really good little two-page explanation of how depreciation usually affects new small businesses, and that's one of your handouts. So I really encourage you to take a look at that, get a cup of coffee. You can read through it in about 30 minutes probably, and that'll be a good 30 minutes of spending it, and then save it in case you need it later on. But now let's hit the highlights of what is depreciation. It's the reduction of the value of an asset with the passage of time, and if you have wear and tear applied to it. So you can buy something new, and the mere fact that it comes out of the store and can't be called new anymore, depreciation sometimes can go ahead and take a hard hit on it. I've sold tractors for a lot of years, and the fact that it was new and on the yard in 0 hours, and it would have, let's say, a $40,000 value. But the very minute that it was put on the truck and left our lot after it was purchased, even if it had 0 hours on it, the value would go down. Why? Because, well, the warranty period has started. We can't call it new anymore. We can't say you're the first owner. Lots of different innuendos there may help it depreciate other than being used and worn at all. So have to keep that in mind. That's a good reason at times why you would delay buying an item until the next year model came out. It's the reason that you would delay buying an item until you didn't want to put it into service until you needed to. I used to hear that all the time when I was selling lots of lawnmowers to commercial mowing companies. I needed to sell them those items in January, but they didn't need to put them to work until June. So oftentimes I would hear, I'm not in favor of buying this now, even though it's got a great price, because I don't lose some of my warranty. Well, I learned right away to stipulate, you go ahead and buy it now. You let me know when you're going to start using it, or I'm going to assume you're going to start using it on May 25th or what date, and show that as the day that it went into operation. Therefore, that's the date their warranty would start. Lots of little things like that can help you make sales. And you need to be aware of what's concerning the customer when that's coming about, because depreciation is a factor not only with taxes, but it can be a major way to close sales if you understand how to make it work for you. So each year, each day, every time we use a tool or drive another mile on a car, we are watching its value go down, and business-wise, that's called depreciation. Let's say, for example, right now, you're just getting started today, and Haley's got $1,000 in the bank. And she indeed is so happy and glad to have that money there and proud of it, because it took a long time to get it there. So today, that business is worth $10,000. No other assets, just that cash in the bank. But she needs to buy an industrial saw for some reason in her business. And to get started, that saw is going to cost her $5,000, $5,000. So the question is, when she goes and buys that saw and uses up half of her money, does that mean that the value of her business was cut in half? Does it? No, it does not. Because on that particular day, that saw becomes an asset in the business. So she got $5,000 cash, $5,000 in the saw, still worth $10,000. But what I want you to understand this afternoon is that tomorrow that saw is going to be used, and that $10,000 is going to be reduced to $9,990 some. It's going to come down. Depreciation is living and breathing all the time, and we have to keep an eye on that. And the way we keep an eye on it is how we write it off and keep up with it on our depreciation sheet, which is a part of your financial statement. Most times folks will be using 5-year write-offs. That is, they're going to write it off over a 5-year period. And what does write-off mean? Write-off means pulling a figure out of the air, applying it to your tax exposure income, and reducing it. So we're going to take this, the government allows you to depreciate your assets. And you can do it over a period of time. You have to declare how fast you're going to appreciate it when you first put them in your books. And this is where a bookkeeper or a CPA comes into play. Usually the CPA will help you set up your depreciation, or a really good experienced bookkeeper. Now, if I don't depreciate this $5,000 saw over a 5-year period, that means that I'm going to say on my book value, it's reducing in value $1,000 each year. And as I take that depreciation, that reduction in value, I'm going to get a bonus. The government's going to give me a little bonus and let me indeed use that write-off depreciation as a tax advantage. During the write-off plan each year that I write off $1,000 and lower the depreciation, I get $1,000 tax reduction advantage. Now, let me say to you here where a lot of people really get confused. I'm saying you're going to get $1,000 tax advantage. I'm not saying you're going to reduce your taxes that you pay $1,000. No. I'm not saying that you're going to reduce your taxes that you are paying by $1,000. I am saying you're going to reduce the number that your taxes apply to. You're going to reduce your tax exposure numbers by $1,000 just on this one saw. So just imagine if you had a large company that was buying a lot of assets and getting started, these tax advantages could become real important to you and save you a ton of money. Now again, that is book value. The book value is the total of all the assets that your company owns. All the assets that your company owns, and that is important. Now, the book value of all the assets your company owns, even though you owe a lot of money on it, maybe you've borrowed, got a lot of debt related, that book value is still going to be there on your depreciation sheet. The amount of money that you owe on it, or the amount of liabilities you have that's securing it, will always come into play, and that's where it gets complicated and you have to sort things out. But book value is not fair market value. So let's now get into the write-offs and the deductions a little bit. How do business deductions work? A deduction, again, is a write-off, same basic meanings. And the more write-offs you have, the less taxes you're going to have to pay, because you'll have a lower number that your tax rate is applied to. As you're doing your purchasing and your business planning, sometimes you can buy too many products in a given year, maybe use up all your write-off ability, and therefore at times, sometimes a customer will postpone buying something that he needs until the next spring, for letting the calendar year in and his tax year in. However, if he knows that he's having a very profitable year and he's talked to his bookkeeper and accountant, and that they've given him a upfront heads up warning, get ready to pay a substantial amount of tax this year, then he or she may decide to go ahead and make this purchase this year so I can have a few more amounts of write-off to apply and maybe save you some tax money. That is tax avoidance, and it's the right thing for you to do. Business expenses, again, are items that are just going to go away. We've already talked about this. So, money that you're spending that you don't have anything to show for it after the money is spent. Capital expenses are buying assets, items that are going to stay around. So it's important. So let's look at a few items, examples. A $250 printer to me will last 10 years probably, and I will probably take that in my company and set it up as an asset and depreciate it. That will help me say that my company is worth $250 more book value. However, a large insurance company with agents all over the country, and every one of them got one of these little printers with them, they would not keep up with that as a depreciated item. They would write it off. So the lesson here is that every company, your company, Dwayne, may handle something very differently than Rebecca's company. Even though it's the same product, Rebecca may put it on her books and depreciate it, where Dwayne has no interest in doing that. He'll just write it off. So there's no rule about you have to do this or have to do that. You got a lot of flexibility, and sometimes that's enough rope to hang yourself, and hence that's where the bookkeeper and the accountant comes in to help you figure it out. But if it was a $2,500 printer with a serial number on it, you could prove when and where you bought it. Indeed, most companies, all companies would probably hang in there and depreciate that out, or call it a capital asset, or going back to the other words, capitalize that purchase. The paper that came with the printers or that you're going to be using, no, that's a general business expense. It'll be written right off. So let's say you're sitting at your desk and you're actually writing a check for these items. And you'll be looking over at your chart of accounts as you write these checks, so you can put an account number beside each check. And I recommend you do that. I've started doing that, and it's very helpful. And so if I write a check for an item that's going to be a capitalized item, I'll put that in a certain account number so that I am keeping up with this as we go. But if it's just a regular business expense, I'll have a separate account number for that item, and I'll record it, and it goes into our books as a general business expense for office supplies or office equipment. Starting out doing that each year, as your bookkeeping information comes to you each month, it'll show how much in your chart of accounts you're spending for this and that, and you'll have a pretty good way to calculate how you're coming along business-wise and what type of depreciation advantage you may be getting at the end of the year. But that's why bookkeeping plays into it all the way through. If I'm buying a set of tires for my truck at $2,000, yeah, that lasts me 6-7 years usually. I depreciate it. But if it's a large trucking company, I would not. Same way if I'm buying an engine, yeah, I'll depreciate that brand new engine. Someone that's buying 50 engines a year may or may not do that. Rental. You're going to have a chance from time to time to rent items. Rent will always be a direct deduction, will always be a write-off. This brings to play in why would you want to purchase something sometimes when you can rent it. Lots of times that decision is based on the tax ramifications to your company. Payroll is always a direct write-off. Fees that you pay to your CPA, your bookkeeper, your person that handles your lawn maintenance or paints or pressure washes your building, any type of fees or labor, always direct write-off. No tax advantage in the long-term depreciation-wise, that as you're paying those bills, that's your cost of doing business, and it's reducing your taxable income. Maybe you're in a business where you will accumulate over months and years certain assets. And I'll use tools as an example. Very few people go down over to the Lowe's or to the hardware store or the automotive place and buy a special tool they need for $4,000. But if you're just getting started, you may be building up your tool set. So I suggest that you keep, again, go to your chart of accounts, have one set up for tools, keep a record of how much money you're putting into those tools, put them in a box so you can show them to someone if they have to see them. And at the end of the year, collectively add up all those tools, and then it would become a capital expense because you've still got it. It's a company asset, and you'd be able to show an auditor right here they are, and that's why I'm depreciating them. Let's say that you'd have been renting a forklift for a while and paying $1,000 a month rent. That's a lot of rent for a forklift. Is that a tangible item? Well, the forklift is tangible, but the rent is not. And even though you paid that $1,000 rent, you don't own the forklift, so rentals are always direct write-offs. How about the delivery expenses for anything, freight costs and things like that? No, they're not write-offs. Or they're not capital items. But I used to rent a lot of forklifts. I had as many as 200 in our rental fleet for a lot of years, and did a lot of renting. And if I had customers that would rent a forklift with, let me say, for $1,000 a month, which is kind of in the general range, and they were renting $1,000 a month for $24,000, they'd have $24,000 over 24 months invested in that forklift. Not. They'd like to think that, and maybe you can consider it that way, but the bottom line is they had $24,000 invested in the use of that forklift. But I like to offer rent-to-home plans to my customers. So after I rented it to them for 24 months, I'd offer to sell it to them for $5,000. They had basically helped me pay for it. Then I can make my profit at the end of the day. That $5,000, yes, is a company asset. You buy that forklift, you put it on your books for $5,000, not for $24,000, but for $5,000. So this is where I draw the distinction between book value and fair market value, because that basically value $20,000 valued forklift would go into your bookkeeping system at a $5,000 value. It would raise the book value of your company $5,000, even though the fair market value would raise the value of your company $20,000. And sometimes it can work the other way. But always remember, real important when you're buying and selling companies, that book value and fair market value, two different things. Let's talk about the main 25 business deductions that folks considered last year. And they'll be the same this year, I'm sure. And we'll talk a little bit about them as we go through. And if you have any questions, just turn on your microphone and we'll chat about it. Business meals are important and they are deductible. And usually for your own, when you're traveling and such as that, you can deduct 50% of food and drink purchases to qualify as a business meal. You might have to keep a chart and a calendar and as to where you were and who you were serving and how it was related to your business and the location of it to qualify. That's why you want to keep up with your business meals. Now, that money that you might spend on the customer is going to be 100% of that cost, so you would keep up with that. And that can get to be a lot of paperwork to keep up with meals and gas and travels and things like that. Several of you have told me during the recent years that there are a number of different software programs that you can plug right into your telephone to help you catalog and list all your business expenses as you go. And then the software will give you a monthly report and an annual report. So you might want to look into that if this is a big factor for you. Next, work-related travel expenses, dry cleaning, car rentals, hotels, airfares, things like that. They're indeed qualify you. Again, you're going to need to be able to document how it's related to your business and keep up with that. That's why you see a lot of large corporations and companies that have their annual business meeting in Las Vegas or in Hawaii or the Caribbean or on a cruise ship So there is some flexibility there that a small business owner that you can use, but you don't need to document how it was business and how the people that you invited to come there, they were going to a business trip and you were able to write off a lot of the expenses, not only for them or maybe for yourself. So get a little bit of advice on that before you go out and spend a huge amount of money planning on using it as an expense. I suggest you talk to your CPA about that. Make sure you got your documentation qualified. But you got a lot of flexibility there, and one of the main reasons a lot of people like to be small business owners. Your work related to your car use becomes very important. Last time I spoke with someone, they said the qualification was 56 cents per mile. I forgot what the gas prices were then. This changes each year. I'm not sure what the deductible is for this year, but let's just say it's 56 cents per mile. That means that for every 100 miles that you drive your car or vehicle on business-related travel, then $56 is going to come back to you. And that's pretty reasonable. The rates are pretty reasonable about maintaining a good late model used vehicle. Usually you can come out pretty well with the travel amount that you get, that the company gets to reimburse you. You want to keep in mind though, if you own the vehicle, it's up to you to pay all the expenses related to it, and then it's up to your company to pay you that per mile record. The company's not obligated to pay for any other items related to the expense of that car. There may be some gray areas there that might apply, but generally that per mile situation is what you get back in return. Business insurance is a 100% write-off. It's not a tangible item that you can appreciate, but business insurance is very, very, very important. Life insurance comes into play here in that the company can pay for life insurance policies on you, and generally that has to be that the company is at least a 51% beneficiary of that policy, but can pay 100% of the amount of the premium. Again, you'll want different states and different situations may apply, and they may change the law from time to time. An independent insurance agent can give you the best information about how the company can help pay for your life insurance policies. Office expenses at home. Most situations are that people would work in their home, call it a home office, and to qualify for deductions, you would write down the percentage of your square footage in your home that you're using up as an office. Example, let's say you got 1,000 square foot apartment and you're going to run your business out of that apartment, and your office space within there is 10%, a 10 foot by 10 foot space for your office. That's reasonable. If that's the case, then you would be able to take your home expenses like mortgage and maintenance and utilities and insurance. You would add all those up and apply a 10% figure to it as a business write-off. Just that simple. But here comes a little problem. Lots of times folks want to get kind of greedy with this and say, okay, I use my whole living room part of my apartment, 500 square feet, for my office and entertaining my customers. I'm not going to argue with you, but an auditor might. So you have to always know that if you kind of get, I'm going to use this term extravagant here with your spacing, an auditor might challenge you on that, and you might have to back off of it somewhat. A way to avoid that argument and a way to have a set amount of money coming to you each month so you don't have to wait till the end of the year to declare a deduction is to have an outside office building or an addition to your house that you can specify this costs this amount of money and it's not my home, it is my office area. And then you as a business person rent that space, that building, from you as an individual. In other words, your company is going to be renting its office from you as a person. And that rent can be whatever is reasonable that you consider, but it's up to you to decide that amount. Write it down on a rental contract as if you were working with a total stranger, and rent that place to yourself for X amount of money per month. And then every month, one of the first checks that you write each month is you pay the rent to yourself as an individual. Good news, the rent that the company is paying to you is a direct write-off from the company. Bad news, the rent that the company is paying to you is taxable income to you. But usually that is just a good wash. The best part of the news is you're able to have a lot more flexibility in putting expenses into that rent or additional expenses that the company might pay related to the office. Because you'll have your standard monthly rental fee, but a part of your agreement is that the company will also pay extraordinary expenses such as loan maintenance, other items, things that you might qualify for, to give you just a little bit of gray area there that the company might be able to pay for a few more items related to keeping the general office up. Let's just leave it at that. You always have to document it. And again, this is a place in your chart of accounts where you'll want to write down these different types of expenses. So as you're paying for them, you'll be able to monitor it each month with your bookkeeping system. Office supplies, pens, pencils, papers, computers, everything related to them, software, which is becoming more and more of a big item, filing cabinets. All these are items that will be direct write-offs. The filing cabinets may be expenses. The desk, office furniture and fixtures are usually expenses. Those would be capital expenses, so you would want to keep those separated. So you would have in your chart of accounts, you would have office supplies, general business expense, and then you might have another account number, office supplies, depreciable or capital office supplies. That way, as you're keeping up your books as you go through the year, you'll have a running total to see how you're coming along. Phone and internet expenses are just skyrocketing now, and you certainly, they will be general write-offs because they're certainly not assets. They just go on and on and on. Now, buying the phones or buying the computers or buying different types of equipment, those items you can capitalize. But the money that you spend to the providers, no, that's all to be written off, but you want to keep up with it and be specific about it. Interest and bank fees. Again, keep your personal accounts separate from your company accounts. And here that you'll be using as a write-off any interest that you pay. It don't have to be on a mortgage, any interest that you pay, and also any bank fees that you pay. In your chart of accounts, you'll want to have a specific account item there so that each month, as you're paying those credit card fees or interest fees on credit lines, you can keep up with that. And on that line and on a lot of these other lines, you will see that if all these are tax deductible, it'll give you a good idea on what your exposable tax hit, your tax income, your exposed income for taxes. You'll be able to look at that and be able to tell basically how your expenses are going to be taking that down to save you tax money. All gets back to working with your bookkeeper and your accounting system and keeping good records. Depreciation is a little more difficult to figure out. Depreciation will be different on some different types of items, and it will vary depending on how you put it into your books and how fast you're going to write it off. So here comes the accountant. Here comes the bookkeeper that's good at depreciation, because that's going to require expertise. And so just know that There's going to be some guesswork in that until they put the pencil and paperwork to it, and sometimes it can't be totaled up until the end of the year. But if you're keeping up with how much you're putting in as capital expenses, you have a general idea on whether it's going to be a small amount, a middle amount, or a large amount. But depreciation will become a major factor for you in a lot of different types of businesses. Professional service fees are always a general write-off, and it also is a good reason that you'll want to keep in your mind, look, man, I really don't want to pay that lawyer that amount of money, or I don't want to pay that CPA that amount of money. That's just costing me. It's costing me. Just keep in mind, it is costing you. But sometimes the advice is saving you money or helping you make money. And that money that you spend to the professional is a write-off. No questions asked. So just keep in mind that's not a bad way to go. You don't want to waste money. You want to shop for the best deal you can get. And the best way to shop is to talk to some of your friends and associates, other entrepreneurs that have gone down this route, have a general idea on what the range of fees ought to be, or who in the area is offering good service for entrepreneurs at reasonable prices. This is a place that the small business centers can help you. They may not be in a position to tell you somebody's name, but they'll know who to suggest you to talk to. And getting started and staying with the right professional is really important. So use this very carefully as good advice and find you someone you can work with on a long-term basis. Salaries and benefits come into play, of course, all the time. Your different write-offs and such as that. How things are affected you versus being an LLC or a C Corp corporation will have a lot to do with whether or not you need to set aside a certain amount of money each month to make payments at the end of the year. Quarterly tax payments can become quite cumbersome, but you want to keep in mind that if you're making money and you're got a large amount of money to be paid at the end of the year, the IRS is going to ask you to start making those payments as you go along so that the government doesn't have to wait till the end of the year to get all their money. That means you're going to need to be doing some estimating and work with your bookkeeper or your tax advisor and set up your quarterly payments 4 times a year where you can make your income tax payments in advance. Maybe you can get it right on the nail and not owe any. Maybe you pay a little too much and get back a nice return. Or if you don't pay in enough, you don't have to ante up a little bit more. But as a business person, I can assure you, you're better off to make those quarterly payments. That way you're not hit with a great big tax bill at the end of the year. So keep that in mind. This would be on your individual payments. Contributions. I like to teach in my seminars that you're going to be known as an entrepreneur, a business owner, as a giver or a taker. And that is the difference in whether you take the high road or the low road in making a lot of decisions that we have a chance to make. The better you are as a person, the better business person you're going to be, I like to say. And charitable contributions are very important to the community. Whether you're dealing with your churches or the veterans organizations or the different types of centers that help people having different types of issues, folks notice who is willing to make a contribution. I know that getting started, there may not be any money left after going to the grocery store to give any away. That seems to be a fact. But I also know, as someone that tries to be a giver, that I can collect a few cans of vegetables for the food drive and come up with some money every Sunday for the church. And I suggest that you try that as well. If you get in the habit of it, it seems to me that you will always get a benefit by being a giver. And oftentimes it really does a lot of good for folks. As you're dealing with individuals, though, you've got to be very careful coming to you as a business person. But I need this amount of money for my annual, for my high school annual. I need this amount of money for my program. brochure I'm going to give away. I need this amount of money for this and that. I suggest that you prioritize your contributions and those that mean the most to you, the ones that you're most involved in a position to help. But do indeed make room for some contributions in your business planning. Plan to be a giver and do that and have in your chart of accounts, list them down who you're going to help. So good luck with that, but be smart. Don't let people take advantage of you as well. Education expenses. We're always needing to educate ourselves a little bit better. I'm at 77 now, and I am in a constant need to learn new things and try to pursue it. And when that pursuit of more education related to my business costs money, costs travel expense, costs tuition fees or books and such as that, they are business expenses. So let me encourage each and every one of you to have that in mind, and you keep up with that, and you list them down as you're spending that money. It may be $10 this week or $100 next week, or it may be some software or some books another week. But if you are good about your record keeping, you'll end up having a right nice business deduction at the end of the year. So keep that in mind. Things that you subscribe to, and this is a good time for me to recommend, whatever type of business you're in, there is a publication related to it. Someone has a current publication related to your type of business, and I really encourage you to subscribe and get your information from sources other than just the internet, because when you sit down with a book, you're looking at ads and you absorb them a lot more as to maybe how this product or service might affect you. Keep that in mind in doing it. Go into seminars and webinars. Let's say you travel to go to a seminar, one of Greg's seminars over in Kinston, and whatever reason you spend the night to do it, and you've got travel expenses, those are deductibles. Just keep up with them as to how it's business related. Child care and dependent care become very, very important. And some companies are offering child and dependent care for their employees, and some independent companies like mine or yours might be paying child care with a company check just so I'll be able to do the job I have to for that. That's kind of a gray area on whether or not you need to pay it personally and then take a deduct for it, or let your company pay for it directly with before tax money. I don't know the answer to that, but it's a question that all of us need to ask if you have dependent children, or maybe some other folks' dependents that you're looking for or working for or looking after in your home. There is a chance that those expenses might become a good business deduction for you. I don't know whether to say yes or no to that, because every situation is going to be different, but I do know that if I had dependents in my house and I was paying other people to look after them while I was doing my work, I'd certainly be talking to my CPA about, can I use this as a business expense? Okay, give it some consideration. Man, in this world of green energy and government offering all types of incentives, we need to stay on top of that, because I know there are incentives for solar panels on certain buildings and different things that we might be doing to our companies or our homes to become more green. I don't know of any specific issues there, other than I did have some folks come by here and give me a quotation on putting solar panels on my office and on my home, and they kept talking about how much of my business would benefit by the tax advantages. I wasn't ready to pursue that, so I didn't get into it. But I've had a lot of people mention to me that they got a tax advantage by becoming more efficient with green energy. That might also apply to vehicles that you might be buying for your company, whether they are electric vehicles or a half and half, so to speak. You might want to give that some thought. I don't have the details on that. Different types of investments indeed may come into play for you. If you are investing in the stock market or other types of investments, You may or may not get business deductions for those. That would be up to a tax professional to give you advice on that. Anything that's related to foreign income, money that you make offshore, that can become very complicated, and the IRS looks at it very carefully. So you want to handle that with kid gloves and with a tax professional. Medical expenses, sometimes companies set up where one of their benefits they offer to employees is to pay a certain amount of their medical expenses, or all of them. When I had employees through the years, I always paid for 100% for anything that was related to accidental injuries, even if it was a little questionable, as long as the employee was on the job. And I had that stipulated. However, I did offer to pay a certain amount of medical premiums and things like that as an employee benefit. And I did that because it was a direct deduction for the company. So if you're in a situation trying to weigh that out for yourself or for possible employees, I definitely suggest that you talk with a CPA, find out how much leeway you have in doing that, or there are limits, and pursue that if you're interested in paying for benefits for yourself or for employees with company checks. Real estate taxes will be a 100% deduction no matter what it is, either for yourself or if the company owns the business. Mortgage interest is always a tax deductible item, and very important. You want to monitor that. And if you do have a mortgage, that means possibly you will get to a point where you have been build up some asset value in that, so that you can use that mortgage to borrow money on, and maybe at some very low rates. Usually those are personal type items, but usually people are doing that to benefit a business. So it's just something to consider as to how you will use that as a deduction as you move forward. Moving expenses, either for yourself or for the company, usually are indeed good deductions. A lot of people don't know this, so you would want to see how it might apply to you or to your company. Different contributions that you make, as we talked about earlier, to your retirement funds or that of your employees are deductible as well, and that is a big, big deduction for a lot of small companies. I use that through the years as I make contributions to my employees' retirement funds on a certain basis, and then a few years we did matching funds. Whatever they put in, I'd match it for them, and that worked out really good for them and for me as well. Advertising and promotion definitely helps you with your taxes related, but I want to tell you now, I'll put a word of caution in here. While it might help you with the deduction, it can kill you with the amount of money it sucks up to try to make sales. You definitely want to know that 99% of most advertising, in my opinion, is wasted money. So we want to make sure we spend our money smartly and to invest in such ways that it becomes a good return on investment. Now, I do get a good feedback on this particular item. People that tell me that what we talk about in our academy classes and our series, like Starts Out Tomorrow Night, really has made a major difference for them, because I share in those every way I know of to save money but still promote your business in such a way to bring in some good income. But those funds, there's usually no question about them. If you spend it for advertising and promotion, it's a direct write-off for you. Now, I'm old school enough to tell you, I also like to weigh every one of these types of expenses with what is the real benefit here? What is my return on this investment? I don't look at considering I'm just going to spend money so I can get a tax deduction. No. Always when we're spending money as entrepreneurs, and especially in startup companies, every expense needs to be bringing us back a justified return on investment. So try to keep that in mind as you move forward. Client and employee entertainment. You can go to spending a lot of money doing this and do a lot of good for your business and creating relationships. But you just want to make sure that you document everything. And the government's not all about buying a lot of liquor and booze or paying for a lot of entertainment. However, they're just fine with treating folks nice, having some good meals and reasonable entertainment and such as that, and covering those expenses and letting you write it off. You just don't want to go too far with it. Okay, keep that in mind. Startup expenses. Most of your expenses are going to be written off anyway, and startup expenses are looked at in a couple of different ways. As you're just getting your business started and you've kept up with your startup expenses that maybe you have accumulated in previous years, if you can itemize those up and document them, in your first year you can probably get up to a $5,000 write-off for that. Maybe more, but maybe the write-offs just as startup in general. But other expenses that go above that $5,000, you might want to itemize them in different categories that we've talked about before. The miscellaneous startup expenses, such as arranging for caterers, special things that you've done for decorations, or just general getting your building in shape, or paying some folks to do some special things for you related to your startup. Keep up with those and itemize them, and at the end of the day, it could be a good tax advantage for you. So let's talk about your first few years in business, doing your business. A lot of folks just say, well, it's going to be a given because of all these deductions and because of having got my business rolling, I don't end up showing a loss. I don't have a loss for my first year. I definitely don't want you to do that, but I know it's a strict possibility. In business taxes, when you lose money one year, you're able to carry forward that loss to the next year. Yeah, so maybe you're not having such a good year this year, but next year it looks like you're going to have a great year. The good news is that loss that you experienced last year, you can carry it forward against future profits. Different businesses, like so many times I have to say, different businesses, different situations, sometimes it's different. But just know that when you're talking to your tax advisor, you want to qualify this with them, because that maybe in your first year, in arranging your bookkeeping, it may be to your advantage to take a larger loss one year than the next. And when you do that, you can carry that loss forward, so you don't have to pay for it, or you can kind of pay for it the second year and reduce your tax liability on your second year too. Just some things you might want to consider thinking about. All right, let me get some Coke here. Thank you all for hanging with us. Is there any questions now before we move into a different topic area? I'm not boring you too much with this tax talk, but it's a thing that we have to do once a year. As Mr. Hannibal says, the taxes just keep on have to be paid, so we have to keep talking about them. Every time I talk to an accountant, I always try to ask the question, what advice can I give to the folks attending my webinars related to taxes? If you had to give them one piece of advice to begin with, what would it be to a new business owner? And every one of them, every time, have told me, Steve, you want to caution people just getting started in business, that as they start taking in money and they start taking in tax money, or they have employees that have tax payment that have to be made, or even for themselves, you got to remember that just because that money is coming into you, you need to separate those tax dollars out of it right to begin with, because you don't own those tax dollars. They're not yours, and you really shouldn't spend them. However, there's no law that says you just can't put it all in a general fund and pay your bills as you go. But I know personally 100 or more friends of mine who started businesses who got in real trouble because at the end of the month, when it was time to pay the taxes, they had remembered, or they had forgotten that tax money had to be paid, and had spent their money for other things. Had thought they had a lot of extra money in the bank, but at the end of the month, when it was time to come up with that cash for your tax payment, it was gone. And that's serious. So it's serious enough that we'll take this time this afternoon that I want to really pound on you to remember that as you are selling, as you are buying items that have related taxes to them, and as you have payrolls that you're making, that taxes are going to need to be paid at the end of the week or the end of the month, that you set up your accounts in your checking system to know and keep a running total on how much tax money you've got to be paid on certain dates, and don't spend that money. You're better off to go borrow it somewhere, but do not borrow tax money to meet your daily bills. Get your ship in shape so that you're able to make those tax payments when they're due, no questions asked, and no sweat. If you start that to begin with all through the years, you're going to save yourself a lot of stressful moments if you're in the habit of spending that tax money and just hope you've got enough cash flow to pay the bills when they're due. So good luck with that. I've practiced it for 50 plus years, and I'd encourage y'all to do it as well. So let's now just talk in general terms. We'll cover some of the items that we talked about up front. It's a good idea. It's a good idea to know where your taxes are going. You want to hire an experienced bookkeeper if you can, someone that's maybe familiar with your type of business. You want to hire a CPA that has a good general knowledge of your type of business. And there's some good reading for you at the IRS website if you got more questions about that. But what is the difference now between tax avoidance and tax evasion? Selling up front, tax avoidance, yes. Tax evasion, no. Tax avoidance allows you to make decisions on how you purchase and rent or lease and the dates you do it at. In different ways, you've got full freedom to do that as long as you're staying legal, but you can rearrange your chess pieces, so to speak. And if you save tax money, that's a good thing to do, and that's tax avoidance, and I want you to get real good at it. Tax evasion is telling lies and misrepresenting things. And when you do that, you stand a chance to get into big trouble, so it's a no-no. Stay away from tax evasion. Now, who is it that we're going to be working with to try to get all this tax stuff squared away? Well, the first piece of advice to do as you enter into the tax season is just don't put all your stuff in a great big filing in a great big bag and carry it to your bookkeeper, your tax preparer, to your accountant, and say, okay, here's my books, take it away. Because every time that individual, that professional picks up a piece of paper and logs it down and applies it into your report, there's a money to be paid because there's time in charge. So these folks charge you for their time. And any time that you can save them in your pre-tax work will go a long, long way. That's why a lot of companies will have their own bookkeeper that prepares the books and takes them to the accountant, so the accountant don't have to do a lot of that bookkeeping. So sort things out, summarize your different types of expenses and totals, and carry that one or two pieces of paper to your professional. And indeed, if they need to see more, they'll ask you for it, and that'll be just fine. But the least amount of paperwork that you ask your professional tax preparation person to do means a better, less bill for you at the end of the day. Now, the people that collect our monies, I don't call them taxes, even though they might be called permits or license or estimates or fees, I don't call them taxes, okay? But you've got a county clerk, you've got a city clerk, a county tax collector at your county seat. In North Carolina, it's the Department of Revenue, so we refer to them as NCDOR. And the U.S. government, IRS, or U.S. Treasury, collects the federal funds. These are the people that end up with our money. And in your handout that I sent to you or will send to you, Indeed has got how to get in touch with folks, just like in this slide, different phone numbers or mailing addresses and things like that to work with. I'm really happy to say that in North Carolina, the Department of Revenue generally is really supportive and nice to entrepreneurs. I'm glad to be able to give you that news. They are generally very supportive and work with our small business centers, putting on different programs there, or letting them know when they're doing webinars that help entrepreneurs. It's a good situation, and we're very fortunate to have that. Generally, the North Carolina Department of Revenue indeed has offices in regional places throughout the state where you can go sit down and talk with someone eye to eye and talk about your issues. They have small business professionals that will be very, very helpful in helping you get set up to pay your sales and use tax or other types of situations. It requires a lot of discipline to do all this, but it's not rocket science. It's items that you can do yourself, provided you've got time and the knowledge of how to put the paperwork together. And indeed, NCDOR will do all they can to help you, and you can generally call them up and talk to them on the phone if you need to. Different types of taxes, a lot of different types depending on the business you're in, but generally they can be summed up with withholding taxes, privilege license, which are generally rights to do business in different locations, unemployment insurance, unemployment taxes, and franchise taxes. Well, congratulations. You don't own a franchise, but you don't get to pay a franchise tax. That's just the name they hang on the bottom of it. And on every state and federal tax return, down at one of the last items is where they've added in $100 or $200 franchise tax. Whether you made any money or not, you get to pay that tax. And I like to say it's just a tax they pay to pay for the paperwork and the mailing. And anyway, you don't have to own a franchise to pay a franchise tax. County taxes now are a different animal. The state and the federal guys are interested in you paying taxes on your income. On your income. The counties, however, want you to pay taxes on your assets. So we're getting ready now to go full circle from where we started this afternoon all the way around to the other side, because the county wants to know all about your depreciated items. The county wants to know about the items you've capitalized, because they are your assets. And the county charges taxes on your asset, be it items that you purchase for your company, land, vehicles, all those airplanes, all those kind of things. And they have a form you'll fill out where you list down the assets that you have in your company. The good news is it's not hard to fill out that form. You know why? Because you take the information directly off your depreciation sheet that the bookkeeper or accountant gives you after they run your records for the year. That's right. So that is a tax form that you don't have to hire someone else to fill out for you, because if you got your depreciation sheet, you can indeed fill out your tax reporting form. Now, I do need to mention to you that every year, usually right at the 1st of December, the county will send every business a tax listing form. And on that form, you fill out just what I was just talking about. But the key is you need to file that form before January 1st. Well, maybe it's January 31st. At any rate, there's a date, either January 1st or 31st, that form needs to be filed. You don't pay the taxes, but you need to file for your taxes. You can't do that if you don't have your depreciation sheet back, and usually the accountants are not going to give you the depreciation sheet back after they do your books until around April 15th. So automatically, I want you to go to the county website, and every county has a website, to their tax department, to their business filing section, and it is usually a place that you can request an extension for tax filing. Go ahead and do that during December, request that extension to April 15th. They will generally automatically send you back an email and do that. If you do not file on time, when it's time for you to pay your taxes, they're going to add a 10% penalty because you didn't file on time. If, however, you got the extension like I've just recommended, you won't have to pay that penalty. But otherwise, there's no chit-chat about it. The penalty has to be paid. So file that business tax form as soon as you get it, or go to the county website and ask for an extension, but put that form away so that you know as soon as you get your depreciation sheet back that you can fill in the information and mail it on in. Now let's do our best to stay off the auditor's radar screen. So we're going to go through here and just talk about some items that will help you maybe not be audited. Less than 1% of returns are audited, but you know how Murphy's Rule works. It might be me or you that gets it tomorrow, but we'll go into it. Be real careful about different things that you can do to stay off that screen. In other words, let's don't raise red flags up and to get the attention to bring them to us. Number one is shady preparers. If you're dealing with someone preparing your taxes that has a record of being fraudulent or making a lot of mistakes, and the feds or the state knows about them, then those individual reports will probably be flagged automatically because they know that these people are not doing right. I don't know that to be a fact, but I think it's a high suspicion that they would. So what I encourage you to do is if someone is saying to you and you haven't met them before, that the reason you need to let them prepare your taxes is they're going to guarantee you a large refund. And no one can guarantee you legally a large refund unless they've completed your tax return. So that's your first red flag not to do business with those folks. Next, if you're going to someone new, get some references that you know. You don't need to be the first person that rides the bicycle with them. Get some references, or otherwise go shop somewhere else. Now, I will say to you that if you are looking for someone, if you're looking for someone this year for the first time to do business with you, to help you with your taxes, there's several folks that are associated with our Academy of Entrepreneurs and Associates. Every small business center probably knows some people that are reputable that are doing taxes. Get some recommendations. I've got several I can give to you, and I'm sure every small business center does as well. Find someone that has a good reputation about helping folks with their taxes. Without that assurance, you keep on searching. As we talked about earlier, you need to report to all your income, and you need to be aware of how many 1099s have been sent out on you. You know how much money you've deposited, but that doesn't mean that the government doesn't know how much money you made, because when they get their 1099s, they know pretty well exactly what you've bought in. And so you just need to be more careful about that. And a way that you can stay out of trouble is to do 1099s on people that work for you. A lot of folks say, I want to do business under the table. Well, the minute they tell you that, that $600 figure needs to be giving you a flag, because I assure you, if doing business under the table is done, it's going to continue to be done, and it's understandable. But you as an employer, if audited and you've paid people over $600 and didn't file a 1099, then you're going to be liable for the responsibility of that, and maybe even the tax money on it. So understand unreported income. As an entrepreneur and a business owner, you're going to get more scrutiny than you did as an individual. File on time if you can, and if you can't, get an extension. But late filing, especially without extensions, is just going to cost you money. And if you keep doing it year after year, it's going to bring extra attention to yourself. If you're wanting to get your business started and you haven't been filing your taxes, let me tell you, it's time to do it. You're going to need to have those tax returns on file, because every bank, every lender, every insurance company everybody you go to ask for credit or credit convenience will probably ask you to see your tax returns. And if you're borrowing big money, they're going to want to see your last 5 years. So if for whatever reason you feel like you didn't file a return, but now you want to be an entrepreneur in business, you need to get past that and go ahead and file those returns. May not cost you a penny, maybe you didn't owe any money, but the fact that the return's not filed doesn't prove it. So talk to people that know how to pay those taxes and know how to do those claims. Remember, CPAs and accountants are out there, that's their job, and sometimes it's the right thing to do to find them, to work with them. So let me encourage you, if you will, to enjoy being in business, enjoy making money, enjoy paying taxes to the point that you can smile, saying, hey, I made enough money, I get to pay some taxes. That means I've been profitable. But be the best person you can do. Let your goodness show. Be kind and gentle and help folks as best as you can. So let me say thank you to you for hanging with us this afternoon. I hope you have enjoyed the process. The handouts are really good. And tomorrow night at 6 p.m., we'll start a new series of courses that cover all the aspects of doing business and then some more too. So I encourage you to turn on your mics if you'd like, ask any questions, or we'd appreciate your comments. Give a special welcome to those who I'm getting to meet with for the first time, and look forward to seeing you online often. You're always welcome to join. Mr. Hannibal, are you still with us? Okay, don't have any comments at all, so take care. Look forward to working with you. There he is. I hear you, Greg. Yes, sir.
Great question. I was in and out working with a client. And Steve always gives 100%. I never say 100% because that is top. If it gives me that, I know you do it. Thank you very much.
Thank you.
So please respond to the evaluation that I send you in the follow-up.
Thank you so much. Your microphone isn't working very well. The week we should hear back from you.
Thank you.
All right. Thank you all. Take care. We look forward to seeing you next time.